So today's cardinal lesson, we're talking about the federal income tax that you pay on your Social Security check. And this is another area that is widely misunderstood. And when I talk to people that aren't on Social Security yet, that are still savvy financially, and I ask them, are you going to pay taxes on your Social Security? Or do you know how much taxes you're going to pay on your Social Security? Most of them, they either don't have a clue, or they assume that they have to pay taxes just like they would any other income, or they'll come back with something that says, well, do I have to pay taxes on that? That's not right. And when I talk to people that are already on Social Security, most of them answer in the affirmative. Yeah, I pay taxes on my Social Security. And then I'll ask them, well, how much? They have no idea. Okay. And this is even people that are in the financial business. So what we're going to do today is we're going to walk you through the process, not so you learn it so you could calculate your Social Security questions. I just want to show you how the government or the IRS arrives at the number of the actual taxes that you pay on Social Security or on all of your income. And then we're going to then go to Tom, and Tom's going to walk you through 3 examples. So, okay, so the first thing, the question is that how much of your Social Security check counts as income? And it's really 3 different numbers are the answer to that. Is that for people that don't have much other income besides Social Security, they don't pay any tax on their Social Security. And for people that have a moderate income, they pay some tax on their Social Security, and 50% of their Social Security income counts when they're calculating their income and their taxes. And then people that have a lot of other income and have a high income, 85% of their Social Security check counts as income in their calculating their taxes. So, and it's somewhere in between those numbers, but it is a little bit of an either or when you go through the categories. Low income, no tax; moderate income, some tax, but probably not very much if you plan things smartly. And then for high income, it's going to be a lot of tax. And again, you got some opportunity to plan things smartly where you can reduce that factor. So the first thing you need to do is calculate. This is a new word that they developed just for Social Security in the tax code. And it's this figure called combined income. And this is only talking about Social Security. And so there's a little calculation that we got to do. Is first, we're going to take your adjusted gross income. And that does not include your Social Security income, just however much all your other income creates, which for a lot of people in retirement, this isn't a big number, okay? But whatever it is, your AGI or your adjusted gross income, and then they're going to add back in the non-taxable interest. So if you bought tax-free bonds trying to not pay taxes in retirement, they get you here because even though they're federal income tax free, they're going to add that number back in when they're calculating combined income. So they're going to get you through the back door, and they're going to add in any tax-free bonds that you own. And then they're going to take half of your Social Security check. And if you're a married couple, that's both your Social Security checks. Add them together, come up with the whole year, and then divide it by 2. So, that's the formula. And what I want to point out is, guess who did that writing on the board, and guess who did this writing on the board? This is me coming in here before I make the session and adding a few things. So I apologize for the bad handwriting. If we look here, and what this does is once you come up with this combined income number and you calculate that, then you're either an individual, you're filing a single individual tax return, or you're filing a joint return, a married couple. So let's look at the individual first. If your combined income is less than $25,000, you pay none of your Social Security gets added into your adjusted gross income. That's a simpler way to put it. If your combined income is between 25 and 34,000, 50% or up to 50% of your Social Security income is counted in your adjusted gross income or in the line before they calculate the tax. And over 34,000, it's 85%. So people even with a moderate income can get into the 85% category. Now you go over to the joint return, those numbers are less than 32,000, it's 0%. 32 to 44,000, it's 50%. Over 44,000, it's 85%. And keep in mind that even if you're in the highest bracket here, 15% of your Social Security income is tax-free. So 85% of it is taxable, okay? So then once we've come up with the number, and we're going to get into the examples later, this will make a little more sense, then we're going to apply the tax rates to that. So, and you're going to find out is I say to a lot of people on the way in that aren't retired yet and they're coming in for financial planning, just tell them, generally, you're going to pay less taxes in retirement, or you're going to be able to keep more of your money. And I think when you get through the examples, when we apply these tax rates, I mean, you look at a married couple, you can go all the way to $340,000 of adjusted gross income, and you're still, the highest marginal tax rate that you pay is 24%. And, you know, they can go up to 83,000 as a couple, and the highest marginal tax rate is 12%. So people that live on less than $100,000 a year of spendable income, they don't pay a lot in federal income tax, really, regardless of whether it's Social Security or just income from other sources. So now I wanted to point out something here is that there's strategies that we can help you with to affect all of these numbers in the future. I mean, like 2022 is 2/3 done right now when I'm making this video. And so there's not much we can do to affect your combined income, your tax bracket, that sort of thing. 2021 is definitely cooked, but 2023 and beyond, we can do planning and we can implement some strategies where you have some control over some of these numbers, generally to reduce your income tax bill. So I want to turn it over to Tom, and I want Tom to talk a bit about Barbara's story, about Beth and John, and then Linda and Alex.
Yeah, so what we're going to walk through today here in a second is I'm going to show you kind of an example of what we do for real clients when they're coming in, more for the planning aspect of looking forward of what things can we do and what taxes are we projecting that they might pay in the future. And so we have 3 examples kind of ranging a different spectrum of clients that we have. And so I'll share my screen here, and what we'll do is I'll show you the software we use. It's an Excel file where we kind of build out people's tax returns. And so this really gives you some idea of what you might pay. And this is what I use just in my day-to-day work when we're really projecting things like Roth conversions, when we're projecting taxes in the future of things that they might pay once they get there. And so the first example is a client named Barbara. She's 65. She's been a client for a while now, and she retired earlier, like the end of last year. And so this year, 2022, she has no income from work, and she started Social Security. And so what we can do is we can go over here and click on this. We're going to add she gets $1,500 a month in Social Security, which is $18,000 a year from Social Security. So this is, again, I'm sort of building out her tax return. I'm showing that she's getting $1,500 a month from Social Security. She's not able to live off that entirely. She had saved money in a 401k that's now in an IRA, and she's withdrawing another $1,500 a month from the IRA, which is, again, another $18,000 a year coming out of her IRA as a taxable distribution. So we're going to go back over to the 1040 here. We've plugged in that she's single, she's widowed, her date of birth is a fictitious date of birth, the January 1st of 57. And what we're going to show you is, let me make this a little bigger, is how this works, how the software accounts for that formula from Social Security. And so she's getting $36,000 a year of income, and only $1,000 of her Social Security check is taxable income. So we have $18,000 that she's getting total, but only $1,000 of that is taxable income. The whole $18,000 coming out of her IRA is taxable, and so she has a total income of $19,000. One thing that was on the board that we'll go back to here in a second is the standard deduction. So she gets a standard deduction of $14,700. So you get to reduce your taxable income by the $14,700. So her total taxable income is only $4,300. That's in the 10% tax bracket. And her total tax is $433. This is federal taxes on a total income of $36,000. She's only paying $433 in federal taxes. And so what's really nice is that, where she's trying to figure out how much should she withhold from the IRA distribution, should she have any taxes withheld from her Social Security? I mean, ultimately, she could come up with that money just out of her savings and pay it there. If she wanted to have some withheld from her IRA distributions, we could do that maybe on one distribution. But at the end of the day, she's not going to owe very many taxes, and she gets to keep all of this money. Whereas before she retired, she was making about, $40,000, $45,000, but she wasn't able to keep most of that, or she had to pay a lot back in taxes, and she had costs like the health insurance and her 401k contributions. And so her net take-home pay was actually lower while she's working than it is now when she's retired, because she gets to keep more of that money, even though her gross income is lower.
It's almost all of it she gets to keep.
Right.
And for moderate income, lowish income people that go on Social Security, I mean, they basically get to keep all their money. And that's why we build retirement plans from the bottom up, is we want to know how much you need to spend and you want to spend in retirement, and net, I mean, spendable money. And then we're going to plug that in, and we're going to work backwards and calculate the taxes to figure out how much you need to draw out of your retirement accounts.
Yeah, absolutely. And I will just point out that this isn't accounting for state taxes. They might have some state taxes. We can't do a video on that because every state has different rules around that. But with our clients, we will sit down and help factor in the state tax piece of it as well. The next example, let me kind of clear this one out. The next example is going to be a couple now. And one thing that we'll see is how that standard deduction is greatly increased when we have someone who is a couple filing their tax return. So let me get rid of the data we just put in here. And this example is with Beth and John, and they are in a little bit different situation than Barbara was. They have a little bit more money. Their Social Security checks are a little bit higher. And so normally, and we do this with all our financial plans, is we start with Social Security because that serves as the base income for the retirement. Now, a lot of times we're recommending people delay Social Security. We'll show that in the third example. But this couple, they took theirs, and John was getting $2,400 a month from Social Security. And so let's see here. Got to do math in my head here for a second. Times 12, that's $28,800 annually from Social Security. And Beth was receiving $1,500, which is $18,000 a year from Social Security. And then they were also distributing $1,000 a month from their IRA. So that's $12,000 a year in income from their IRA. And what was unique about them is they had savings in other buckets. So they had some IRA money, some taxable money, and then some Roth money, and then Social Security. And so we showed them how they can take a mix of these accounts and really control their taxes. And so I'm going to go down here, and we're going to look at show what we recommend is they take a taxable distribution from their taxable account. And so with taxable accounts, you don't pay taxes on the full distribution. You only pay taxes on the gain. And so you can pick and choose which positions you sell and realize whatever gains they're there. Again, there's a difference between short-term gain and long-term gain. And so in their situation, they had a lot of long-term gains with some gains in there, but a lot of principal. And so what we showed them doing is selling $50,000 of their taxable account, which is raising $50,000 for their spending. And on that, they had a cost basis of $30,000. So of the 50,000, 20,000 of were gains, and that's taxed at the long-term capital gain rate, which for them was going to be pretty low. And so let's just go back over what we did here. It was a married couple. They're both over 65. They have $1,000 a month from their Social Security. They have over 45,000 or $1,000 a month from their IRA. They have over $45,000 from Social Security combined, and then money coming from this taxable account. And so when you get done with all of these things, and so the 12,000, only about 15,000 of their 16, just under 16,000 of their Social Security check is taxable. So they're still getting a lot of their Social Security tax free. They have their capital gain here. So they have a total adjusted gross income of 47,690. You then get to take the standard deduction. For them was 28,700. Again, that's much higher for a couple than it is for a single filer. And so their total taxable income was 18,990, but most of that was from their capital gains. And with the income bracket there, and their capital gain, long-term capital gains rate was actually 0%. So you can see from a federal tax standpoint, they raised $50,000 from their taxable account, just call it $46,000 from their Social Security, plus another $1,000 from their IRA. It's over $100,000 a year of income, and they have a tax rate of 0%. I mean, they don't pay any federal taxes on this money, which
Well,
is
I think
just
the key to this thing was as well is that this couple has about $5,000 a month of recurring income between their Social Security and the money they're taking out of their IRA, which is $60,000 a year. And that's what they're living off of. And their taxes were how much, Tom, of that 60,000?
Yeah, zero. They don't pay any taxes.
So again, it's like the first example is to people that have high Social Security checks or high-ish Social Security checks, and then they have low other income by choice, because they could take more out of the IRA, and that still amounts to $60,000 a year of spendable money. Now, in this example, we threw in the capital gain so that they've got some cash over to the side, but it's still a couple spending 60 grand a year is paying no income tax. Okay. And this is the kind of thing that is makes people happy that are coming into us with planning. And so let's go to the third example, which is not as simple, Linda and Alex.
Yeah, so let me reset all these things, and then we'll go through another example here.
Yeah, and Linda and Alex, they need $8,000 a month of spendable money. So these people have a higher lifestyle, more expenses, and people at this level, it's almost $100,000 a year that they need to spend. They come into us thinking they need to make 150 or 160 or 170 to net 100 grand or 96 grand or whatever 8 grand a month is. And they're way overshooting the income that they need to get. So,
yeah. And then with Linda and Alex, they had not started Social Security yet. One of their questions to us was, do we need to start Social Security? And this is a question we get all the time of people who are retiring and they're working their whole life, they're getting a paycheck, and then just their mind, when you retire, you start Social Security because you need to bring income in. In the meantime, a lot of these people have significant savings in their 401ks, their IRAs. They have money that they saved up over time. And when you ask them before retirement, what's this money for? They say, oh, it's for retirement. Well, we get to retirement and then they don't want to spend it. And they say, well, what were you saving it for in the first place? And so oftentimes we have to walk people back and show them the benefit of delaying Social Security and maybe drawing down their IRAs. And we'll talk about some things to be mindful of there. But for these clients, for Linda and Alex, we've recommended that they delay Social Security and just take out $9 grand a month of their IRA, which is $108,000 a year. And so their only income now is distributions from the IRA. Again, both were over 65. It was a couple. So you have a taxable income of $108,000. Again, all from IRA and 401k money. It's all taxable income. You get the standard deduction of $28,700. And then that gets you to a taxable income of 79,300 with total tax of $9,091 that they're paying in total tax. And so after all that's said and done, they're able to get the money they need to live off of out of the IRA. This couple happens to live in a state with no state tax, so we don't need to worry about that for them. But they're able to keep, right at $70,000 a year.
No, it's more than that, Tom. It's $8,000 a month. It's $96,000 a year.
That's right. Well, you're right, because I was subtracting it from the taxable income. You're right. It's over $8,000 a month because they're getting a total income of 108,000. They're paying 9,000 in taxes, so they're over the $8,000 a month that they're getting currently, which is what they need to live off of.
I mean, when we're talking about them specifically, we arrived at this number that they want to spend $8,000 a month. They got some vacations planned in there, some gifting to the kids. So they're not going to blow all this money every month, but this is the number they wanted to use, and they have the money to back it up. They've got large IRA balances, 401k balances. They have some other savings, other investments. So when we get down to retirement, I said the same thing to them, is to get $8,000 a month, you're not going to pay near the taxes net. You're not going to pay near the taxes you did before in retirement. And Tom ran through this drill. That's how we came up with the $9,000 a month that we're pulling out of the IRA. And they're paying $1,000 in taxes essentially and living off the $8,000. And they're delaying their Social Security checks so that by the time they're both 70, or he's 70, she's 69, they're going to have like $6,000-$7,000 a month, but $6,000 a month of Social Security. So of that $8,000 that they need to live off of, $6,000 of it's going to come from Social Security.
Yeah, and what we can do then, and when we start projecting several years in the future, it only can get so good because we don't know exactly what the tax brackets are, but we can start using today's tax brackets and really start guessing at what it would be in the future and just show them it's like, okay, if we're delaying Social Security, we're living off your IRA, maybe doing some Roth conversions on top of that to get money into the Roth account. Now, when you get to where you have maximized your Social Security, it's the highest it can be. You live off that, you get to keep more of that tax-free because of that formula that Hans went over at the beginning of the show. They get to keep more of that tax-free, and we can really start controlling how much taxes they pay along the way. So there's a lot of flexibility that people have in retirement in terms of their taxes. And so there's just a lot of things that you can do. One thing that, we don't want you guys to take this as advice and everyone go start doing this. We need to look at your investments. There's a thing called sequence of returns risk. If your account is way low, there could be some reason to start Social Security early. I mean, there's more that goes into all of this than just the tax piece of it. But this is a critical component that we look at when we're doing financial plans.
I mean, it all goes back to how much tax are you going to pay on your Social Security?
Right.
And I want to finish by telling you what we did with this couple, because so they were just amazed at $108,000 worth of gross income, $12,000 or a little less than that of taxes, $96,000 of take-home pay, and then we can just spend that, and they're only having to make a reduction out of their IRA of $108,000, and therefore they can delay Social Security for 4 years or 5 years. I mean, they were thrilled with that. But then I said, well, you're only paying $12,000 in federal tax. You think that's a good idea? And they thought it was wonderful. I said, now I'm going to talk to you about something else. Is you're only in the middle of this bracket right here. So the 22% tax bracket, when they're at 108,000, still has another 70,000 that they could go and still only pay 22% federal tax on their money. So what we're talking about is Roth conversions. So the first thing we're going to look at with Roth conversions is, for this couple, is $70,000 of Roth conversions this year to get them right up to $178,000. The second thing we're going to look at is going up to the 24% bracket, which is $340,000. So that would be doing $220,000 of Roth conversion this year. So, they come into me to have me lower their taxes. And what I end up doing, or Tom and I end up doing, is raising their taxes now to an acceptable level to do Roth conversions to prepare for a low tax or a tax-free future. Because if they're delaying their Social Security and none of this is going to apply to them, or the Social Security, for 4 more years, what we want them to be able to do is when they get this big Social Security check, we don't want to have a high other income. And so let me talk about what we can do in some strategy is that if we pull money later in retirement out of a Roth, that's tax-free, and it doesn't count in these formulas for this and the Medicare tax, IRMA. So this is the way I've set my deal up. I have a big pot of Roth money that I'm going to, when I get on Social Security, that's when I'm going to start making withdrawals from my Roth. And they're going to be tax-free, and I'm not going to pay any taxes on the Social Security either, or very little. And then I also have a big pot of life insurance cash value that's built up and a lot of accumulated interest that I've not paid taxes on. And that's another place that I can go and pull out money that won't affect this formula. And then there's one other problem for Linda and Alex that we didn't talk about, is they have some pretty substantial brokerage accounts where they have money that they're earning in interest or gains that they're not spending, but they got to pay tax because it's in a taxable account. And so that enters into that chart that Tom had there. And so what we recommended for them is to move some of that into annuities so that they're still going to get paid interest, but they're not going to have to pay taxes on the interest till they actually draw it out. So there's a lot of levers that we can pull, a lot of different strategies to just keep you in a low tax bracket through the whole of your retirement. So I believe we've gone over enough today. I'm Hans Scheil, and I thank you very much for listening.
Thank you.